Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TERNS Pharmaceuticals Inc. Annual Report. TERNS Pharmaceuticals Inc. offers a range of innovative products and services in the pharmaceutical industry. At its core, the company specializes in developing small molecule product candidates to treat complex diseases such as cancer and obesity. One of the key areas of focus for TERNS is oncology, where it is working on TERN-701, an allosteric BCR-ABL tyrosine kinase inhibitor that has shown promise in treating chronic myeloid leukemia, CML. This product candidate is currently in Phase 1/2 clinical trials. In addition to its work in oncology, TERNS is also exploring the treatment of metabolic disorders. The company's TERN-501 is a thyroid hormone receptor beta agonist that has been designed with enhanced metabolic stability and liver distribution. This product candidate is being tested in Phase IA clinical trials for the treatment of metabolic dysfunction-associated steatohepatitis, MASH. TERNS' portfolio also includes the TERN-801 series, which are small molecule glucose-dependent insulinotropic polypeptide receptor, GIPR, modulators aimed at treating obesity. These innovative products have the potential to make a significant impact in the fight against this growing health concern. Overall, TERNS Pharmaceuticals, Inc. is a clinical-stage biopharmaceutical company that is pushing the boundaries of what is possible in the treatment of complex diseases. With its focus on developing small molecule product candidates for oncology and obesity, the company is well-positioned to make a meaningful difference in the lives of patients around the world. The list of businesses and services provided by TERNS Pharmaceuticals, Inc. includes development of small molecule product candidates, clinical trials for cancer treatment, CML, treatment of metabolic disorders, MASH, obesity treatment using GIPR modulators. TERNS Pharmaceuticals, Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. TERNS Pharmaceuticals, Inc. trades at a higher price-to-book ratio of 5.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 2% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for companies can be attributed to several key factors. Regulatory approvals and compliance are crucial, as they enable the commercialization of product candidates and the receipt of milestone payments from collaborations and licensing agreements. The success of these collaborations also contributes significantly to revenue growth. Additionally, sales-based royalties, upfront payments and fees, regulatory exclusivity, and orphan drug designation can all contribute to increased revenue. On the other hand, several factors can lead to a decline in revenue. Patent invalidity or non-infringement certifications can render products obsolete, while clinical superiority of subsequent same drugs can erode market share. Delays in clinical trial completion, termination of trials, and regulatory holds or denials of approval can all hinder revenue growth. Furthermore, changes in governmental regulations, lack of adequate funding, patient enrollment difficulties, and competition from other clinical trials can also contribute to a decline in revenue. Other factors that may impact revenue include governmental authorities' coverage and reimbursement policies, private health insurers' coverage and reimbursement levels, regulatory investigations or product recalls, and product liability claims. These factors can have a significant impact on a company's bottom line, making it essential for companies to stay informed about these developments and adapt their strategies accordingly. The financial performance of the company has been marred by significant losses over the past 2 years. In 2025, the net income plummeted to $96.2 million, a staggering loss that marks an increase of approximately $7.3 million from the previous year's net loss of $88.9 million. This decline in net income is largely attributed to increased research and development costs and manufacturing expenses, which have eaten into the company's profit margins. The company's inability to turn a profit is evident in its lackluster profit margins, which are not applicable due to the significant losses incurred. The decrease in profit margins can be directly linked to the rising costs associated with research and development, as well as increased manufacturing expenses. These factors have collectively contributed to the company's financial struggles, resulting in consecutive years of net losses. The company's financial performance is a cause for concern. Despite its efforts, the business has not been able to generate positive operating cash flow since its inception. The company's history of significant losses, as stated on page 44, suggests that it is struggling to break even. Furthermore, the net cash used in operating activities, as shown on pages 109 and 117 for both 2024 and 2025, indicates a consistent trend of negative operating cash flow. This trend is alarming and raises questions about the company's ability to sustain its operations without external funding. The lack of positive operating cash flow is a significant red flag that warrants attention from investors and stakeholders. Management's outlook for the company is one of cautious optimism. Despite expecting to incur significant expenses and operating losses in the foreseeable future, management believes that existing cash will be sufficient to fund planned operating expenses and capital expenditure requirements until 2031. However, substantial additional funding may be needed in the future. The company's strategic priorities are focused on advancing its product candidates through clinical trials, with a particular emphasis on TERN-701. Management aims to initiate Phase 3 clinical trials for this product candidate by late 2026 or early 2027, and evaluate its efficacy and safety compared to existing treatments. The goal is to capture significant share and peak revenues of over $4 billion in the frontline indication. However, management also acknowledges several risks and uncertainties that could impact the company's strategy. These include patent infringement, litigation, regulatory changes, and data protection laws. To mitigate these risks, management must balance its focus on advancing product candidates with protecting intellectual property and complying with regulatory requirements. Overall, management is committed to navigating these challenges while driving the company forward towards commercialization. The company has made several significant transactions in recent years. In terms of acquisitions, one notable deal is pending with Merck Sharp and Dome LLC, which is expected to be completed by the second quarter of 2026 at a price of $53 per share. On the other hand, the company has also engaged in divestitures. One key example is the termination of several employee incentive plans, including the 2017 Equity Incentive Plan, 2021 Incentive Award Plan, and 2022 Employment Inducement Award Plan. Additionally, the company has delisted from the Nasdaq Global Select Market and deregistered as a reporting company under the United States Securities Exchange Act of 1934. These moves suggest that the company is streamlining its operations and reducing its regulatory obligations. The company's dividend policy is clearly outlined in its financial reports. According to the information provided on page 100, one key aspect of this policy is that the company has not paid dividends. This decision suggests that the company is prioritizing other uses for its profits, such as reinvesting in the business or reducing debt. It appears that the company's focus is on internal growth and development rather than distributing earnings to shareholders through dividend payments. While there is no mention of share buybacks in the provided summaries, it can be inferred that the company is choosing to allocate its resources towards other strategic objectives. There are valid concerns about inventory buildup and supply chain disruption that could potentially impact a company's operations. One of the main concerns is the risk of delays in manufacturing and sales due to lack of funds, which can lead to inventory buildup. Another concern is the potential for supply chain disruption caused by third-party manufacturers' inability to meet regulatory requirements or obtain necessary approvals. This can result in significant delays in product delivery and potentially disrupt the entire supply chain. The FDA shutdown and public health events can also cause disruptions in the supply chain, particularly if third-party manufacturers are unable to obtain approval or meet quality standards. Additionally, raw material/component supply disruptions can further exacerbate these issues. Furthermore, there is a limited number of suppliers for raw materials, which can lead to significant delays in product delivery. The company may face challenges in replacing manufacturers and obtaining necessary approvals, leading to potential shortages in supply. Overall, these concerns highlight the importance of careful planning and risk management in maintaining a stable supply chain. That concludes the financial summary for TERNS Pharmaceuticals Inc. Feel free to comment below, and I will be happy to answer them when possible.